So we could then go through it. I think we can do it very fast. Since we are aware of how to consolidate, I don't think we have a lot of problem with consolidation. It's about just mentioning some few things, is it? So that is our question, what? 3 or 4? 3. That is general consolidation in case of where we have subsidiary. Consolidation where we have a case of subsidiary. And when consolidating, we follow the same principles. The same principles whether we are consolidating a directly owned subsidiary or a subsidiary. It's all about combining, determining the NCR. So we can go through that question 3. That question 3, we see whether we can manage to complete it within the remaining time. Or we have all the time. We have all the time. So we read. We are given Jana Limited. Jana Limited is a company quoted on the Nyumbani Securities Exchange. It distributes a wide variety of household machinery, including sewing machines. On 1st of October 2010, it purchased shares in Leo Clothing Limited. The group purchased shares in Kesho Limited, a nationwide chain of retail shops dealing in casual wear, on 1st April 2011. All the 3 companies make up the accounts to that 1st March each year. The draft statement of comprehensive income for the year ended that 1st March 2013, and the draft statement of financial position as at that 1st March 2013 are as follows. There we are given the statement of comprehensive income showing sales, cost of sales, gross profit, distribution cost, administrative expenses, operating profit, finance cost, profit before tax. We have taxation. That is current tax as well as the deferred tax. Current tax as well as deferred tax. Then profit after tax, dividends payable, retained profit for the year, retained profit brought forward, and also retained profit carried forward. Then we have statement of financial position. We have non-current assets, property, plant and equipment, investment in rail, investment in cash, current assets, current liabilities, Then we have net current assets, equity and liabilities. We have ordinary share capital, retained earnings, shareholders fund. That is deferred tax liability also. Then the following additional information is available. Number one, we have on the 1st of October 2010, Jana Limited acquired 16 million shillings 10 ordinary shares in Leo Clothing Limited for shillings 602 million, when the credit balance on Leo's retained earnings was shillings 490 million, and the fair value of its identifiable net assets was equal to the book value. Leo paid no dividends in the year ended that 1st March 2011. So there we are given this company called Jana acquiring shares in Leo on that date given 1st of October 2010. And it acquired 16 million shillings 10 ordinary shares in Leo. If you go to Leo Limited statement of financial position, you find ordinary share capital is equal to 200, is it? If you divide by 10, you get 20, is it? So Leo had 20 million issued shares. And this Jana acquired 16 million, is it? 16 million out of the 20 million. That gives us what proportion of the shares? 16 over 20 times 100 is what percent? 80%, which we can see there. Leo is a subsidiary of Jana. Leo is an 80% owned subsidiary. It's an 80% owned subsidiary. And as at that date, we are given that the pre-acquisition profit was shillings 490 million, and also the book values of the net assets were equal to the fair values. So there were no fair value adjustment as at that date. And also we are given the cost of investment was 602 million. So having been provided with such information, then what was the goodwill on acquisition of Leo? If you are to compute goodwill, because whenever we are consolidating, we must always do what? One, calculate goodwill. So what's the goodwill on acquisition? Acquisition of Leo Limited. Goodwill on acquisition of Leo. How do we compute goodwill? And we are not provided with the fair value of NCI. Therefore, it means what? We use the passive goodwill method, whereby we simply take the cost of investment, which we are given it is 602. And you can see in the balance sheet of Jana Limited, you can see Jana invested in 602. So it carries it as an current asset. It's an investment. Less net assets acquired. Net assets acquired when? As at the date of acquisition. Net assets acquired. And the net assets acquired comprises of what? What were the net assets as at the date of acquisition? They were equal to ordinary share capital. In this Leo is 200, is it? Yeah, net assets equals equity. Equity as at the date, the cost of investment was paid, which included ordinary share capital plus retained profit, is it? Pre-acquisition profit. Profit as at the date of acquisition, given in that note 1 as 490. That gives us total net assets equals 690. And the parent acquired 80% of the ordinary shares, which means it acquired 80% of the net assets. Therefore, 80% of 690 equals what? 552. 552. And that gives us, now you can see the cost paid is much higher than the assets acquired. The difference is goodwill. And that goodwill equals what? Equals 30. So that is the reason why we are provided with that information. Number 2. On 1st April 2011, Leo Clothing Limited acquired 7.5 million shillings 10 ordinary shares in Kesho Limited for shillings 405 million. So again, this Leo acquired shares in Kesho on 1st of April 2011. And it acquired 7.5 million shares out of how many million shares in Kesho? So Kesho's issued shares equals how many? Equals 100, that is share capital, divided by per value of each share, that is 10. So 100 divided by 10, you get 10 million shares, is it? And this company called Leo acquired 7.5 million out of the 10 million. So what is that proportion? 7.5 over 10 times 100, you get what? 75%. So then you can see Kesho is also a subsidiary of Leo, and Leo is a subsidiary of Jana. That means then Leo is a subsidiary of Jana, and Kesho is a subsidiary of Jana. So they are all in one. Why? Because Jana can control Leo, Leo can control Kesho. That's the case. So Jana through Leo can control Kesho. So control exists. And therefore, that is a group of companies. It is a group comprising of parent, Leo, and Kesho as the subsidiaries. Then, if we continue with that, we are given. At this date, there was a credit balance on the retained earnings of Kesho of shillings 300 million. That is what we call pre-acquisition profit. Profit that existed as at the date of acquisition. Profits that existed as at the date of acquisition. Then we are given the fair value of the identifiable net assets on this date approximated book value, except for a leasehold property whose book value was shillings 40 million below its fair value. This property is depreciated to nil residual value over the lease term. On 1st April 2011, there were exactly 10 years remaining on the lease. The depreciation charge based on remaining lease period is to be included in administrative expenses. So in this case, we are given all that information. We are given that, we know that as at the date of acquisition, the assets and liabilities of the subsidiary need to be measured at their fair value. That is what we call fair value adjustment. And in Leo, we were given that the fair values of the net assets were equal to book value. That is not the case now in Kesho. In Kesho, we are given that the fair values of most of the assets were equal to book values, except a leasehold property, whose fair value was higher than the book value by shillings 40 million. So that means we have fair value adjustment, a revaluation adjustment in the books of Kesho. So how do we deal with the fair value adjustment? Fair value adjustment in Kesho. How do we deal with that? How do we deal with fair value adjustment in the subsidiary? The first thing is to check whether the subsidiary recorded. Did it record such revaluation? Did it record such revaluation? Yeah, that is, did it record such revaluation? Did it record? And when an item is revalued, when an asset is revalued upward, we usually recognize a revaluation reserve, is it? So if then you find that there is no revaluation reserve, like in our case here, it means they never recorded, is it? The subsidiary case never recognized the 40 million. Because the subsidiary may or may not adjust its own books. But when we come to consolidate, we need to do what? We need to incorporate such revaluation. We have to include the 40. So when we include the 40, it means we debit the asset, we credit what? The revaluation reserve, is it? So now our books have revaluation reserve. Yeah, this failure to record means what? There existed a reserve not recorded in the books, is it? So if and when calculating goodwill, you must consider that revaluation to be part of the net assets. It existed, but never recorded, is it? That way. Then the second item, because it was not recorded, we now have recorded. Secondly, you ask yourself, is it a depreciable item? A depreciable item always have got what? A definite useful life. It has a definite useful life, such that depreciation should be calculated over that period, or the asset need to be depreciated over that period. We need to depreciate it over that period. So then, in this case, is it a depreciable asset? Yes. It's a leasehold property, which shall be depreciated over the lease term, is it? Yes. Because that is when it will revert back to the owner. And therefore, as at that date, it will cease to give benefits to the entity. And therefore, that's the reason why we depreciate it over that lease term. We depreciate it over that lease term. So in this case, we are given that this property had a remaining lease term of how many years? 10 years. Therefore, we should depreciate the leased property over 10 years. Note that whatever was recorded in the books was the book value. That is what they depreciated. Failure to recognize revaluation means what? Depreciation was provided on the book value that existed as at that date. But IAS 16 requires what? When an item of property, plant, and equipment that is measured using the model, that is the cost model, is revalued, then the depreciation of such shall be provided over the remaining useful life based on the revalued amount. That is the requirement of IAS 16. Such that because they never recognize this 40 devaluation, it means the 40 was not depreciated. And therefore, we needed to depreciate it over 10 years. Over 10 years. So that means every year 4 million, is it? 4 million depreciation. We can see cash flow, or we can see the years of this company ends on that 1st March, is it? That 1st March. Cash was acquired 1st April. That means it was acquired right at the beginning of the year, which means full year depreciation. The financial statements given here are for the year ending that 1st March 2013. And since the date of acquisition, 1st April 2011, is how many years? The first year must have ended that 1st March 2012. Second year, that 1st March 2013. So this is the second year, is it? Which means this depreciation of 4 million per annum has not been provided for 2 years. So we need to provide 8. What is that? Yes. If you check the financial statements given, they are only for this year. We have the income statement for the current year, which means the current year financial statement, we only provide 1 year depreciation. Right? The other 4 million should be charged against the retained profit brought forward. Is it? Yes. The profits of the previous, because that is what it will affect. So that is that. So we will charge this 4 to the current year's income statement. We are told to classify it as administrative. And the other 4, we charge it against the retained profit brought forward for the previous year. I think that one is the way we deal with it. And you find that adjustment almost everywhere in all consolidations. Then, still on that point, we are given the cost of investment and even what? The fair values of the net assets were equal to book value, except this property whose fair value was 40 million above the carrying amount. So what is then the goodwill on acquisition of cash? We can still calculate goodwill. Goodwill on acquisition of cash. Cash is a subsidiary. We are determining this goodwill who is consolidating the parent, the ultimate. So we are determining this goodwill here. And the cash you can see, it is not a direct investment, is it? It is an indirect investment through Leo Limited, is it? So that means who paid the cost to acquire cash? It is? Yes. This is an investment of this Leo. That investment of shillings 4 or 5. It is Leo that paid the 4 or 5 and not Jana, is it? So what is Jana's investment in cash? It is what? It is only 80% of this, is it? Yes. Because it owns Leo 80%. The other 20% is by NCI. So the NCI in Leo also invested in cash. 20% of 4 or 5. And we are calculating goodwill here. So therefore, the cost of investment will be equal to 80% of the 4 or 5, which gives you what? 70? 324. That is the cost of investment. That is the cost of investment. That is the cost of investment. That's the cost of investment. That one. 324. That one. Then less net assets acquired. Less net assets acquired. What is the value of the net assets that were acquired? And we can see the net assets were not the net assets in Leo, but the net assets in cash. So what were the net assets in cash here? What were the net assets in cash? We use equity, is it? That is equal to ordinary share capital 100, is it? Plus there was revaluation of what? 40. Plus there is what? The pre-acquisition profit of shillings what? 300. So the net assets were equal to 440, is it? What did the parents acquire? What did Jana acquire? See, you see, now the 440 is here. The 440 is in cash. The net assets in cash. What is the parent share? Parent share of these 440 is what? Eh? It is what? Yeah, you can first share it to Leo. Leo's share is 75% of this. Isn't it? So whatever you get, parent share is 80%. Right? And that is the reason why we take 80% of the 75%. What is that? So 80% of the 75% of the 440, you get what? You get what? Eh? 264. And therefore, goodwill on acquisition equals what? 60. That is the goodwill we are given like that. We calculate partial goodwill just that way. Then, so you can see computation of goodwill for a subsidiary, is it? There. So that's the end of that number 2. Go to number 3. Number 3, 4, 5, 6. These are the ordinary adjustments we find in all consolidation. Yes, we find in all consolidation. We find in all consolidation. So now we go to number 3. We are given in the year ended that 1st March 2013, Kesho Limited sold to Leo Clothing Limited goods at a price of shillings 80 million. Kesho Limited had marked up these goods by 100% on cost. Leo Limited held 50% of these goods in stock on that 1st March 2019. One, this is sale by Kesho to Leo, is it? A subsidiary selling to the subsidiary. They are all in one group, is it? Therefore, it is an intra-group sale, is it? It is an intra-group sale. And we always say that for intra-group sales, we eliminate them in full, is it? We eliminate them in full. It is important to note it. Intra-group sales. And it is Kesho selling to the goods worth shillings 80 million. That must be eliminated fully. Secondly, were all the goods sold? If all the goods were sold, no adjustment. But if they have not been sold, that means some of the goods are still in stock. It means we have what? Unrealized profit, is it? Like in our case, we are given Leo Limited held 50% of these goods in stock. Yeah. And these goods had been sold at a profit, is it? So if 50% are still in stock, it means what? The profit on those goods is still unrealized, is it? So we require to know what was the percentage profit. And we are given those goods had been marked up by 100% on the cost, is it? That is markup, is it? So what is the markup included in half of these goods? Because half of the goods are still in stock. 50%. So we get value of goods in stock is 50% of what? 80. That is 40 million. 40 million worth of goods is still in stock. What is the profit in the 40 million? What we are given is markup, is it? 100% on the cost. That is markup. 100%. 100% you write like that, is it? That's what we mean by 100%. This is markup. Somebody told me that we do this. Yes, it comes from this formula. Right? We have cost plus profit equals selling price. Yeah, whenever you are selling goods, you buy them at a certain cost, you add your profit, then you sell them, is it? So we can express this profit as a percentage of cost or as a percentage of selling price. When we express it as a percentage of cost, we call it markup. Yeah, it is equal to profit divided by what? Cost. Yeah, times 100. In most cases, we are given the markup. For you to calculate one of those three items, you must have two of them, is it? Yes. So if you are given a markup at the cost, then you must look for profit. So given markup, profit will be equal to what? It will be equal to markup times the cost of the goods, is it? Yes, that is what should happen. And like for example now in our case, whatever we are given is only the what? The selling price, is it? We are given this one. We are not given the cost, but we are told they were sold at 100% markup, is it? Yes, 100% markup. So now, if I may ask, calculate the profit in this item if they are at 100% markup. You find you cannot apply that markup directly to calculate the profit, is it? Because what we have, the item is not what? Is not cost. And that is why we are forced now to express this profit as a percentage of the selling price, is it? Yes. So, and we call it what? Margin, which is equal to profit divided by the selling price. Such that to calculate profit, given margin, we make it the subject, and it will be equal to what? Margin times the selling price, is it? Yes. And now, this is the selling price. So we only require what? Margin, is it? And it is possible to convert markup to margin or margin to markup, is it? Because you can see the formulas. This is cost over cost, profit over cost. This is profit over selling price. What is that? And like for example, here we are given, they were sold at a profit markup of 100%. That tells you, if you apply this formula, it is profit divided by what? Cost, is it? Which tells you that profit is 100%, and the cost is what? 100. So that means selling price is 200%. Because this plus this is equal to 200. I'm just doing that because I'm using the formula. Ili tuache kusema add this to this. So now, what is margin? Markup is this, is it? What is margin? It will be profit is 100, is it? And the selling price is what? 200. So I've been able to change my markup to margin with ease, is it? Using ratios. That is what happens. Even when you are told that markup was what? 5/12 markup. What is that? It means what? It means profit is 5, and the cost is 12. So the selling price is 17. And therefore, markup of 5 over 12, margin is 5 over 17. What is that? Profit over selling price. It is as simple as that. And that is why we go on and generalize that to calculate margin. We simply add the numerator to the denominator. Mtu mwenye anasema hivi anakuaga anafanya hivi. Sawa. Aliitoa hapo akaona let me simplify it. Add the numerator to the denominator. And that is the end of the story. Sini hivi. Siwe kufanya hivi unaona inaingia. Sini ukweli. Yes. So the person who I can't remember you. Usifikirie naweza kuvuka hata siwe, lakini there is somebody who told me that if you can explain that concept, the better. You know yourself. You are not the only one. It may be everything. So you have helped so many people, isn't it? Yes, because I have taken that time. That is the only thing that can make you miss this question. Yes, especially the income statement. What is that? Because you can see it is affecting your cost of sales, is it? Yes, because of that issue of unrealized profit. It is affecting your inventories. It will affect your profits, is it? It will affect your NCI. So you can see how sensitive it is. So in this case now, we are given that goods were sold at a profit markup of 100%. So that is what we are given, is it? Therefore, and what we have is the selling price of those goods. And therefore, we must change to what? To margin, so that we take the margin times selling. So in our case, margin equals what? 100 over 200. So we take the value of goods in stock. We are told 50% of the goods are still in stock. So that means 40 million is still in stock. What is the profit in the 40 million? Multiply by margin, which is 100 over 200. And you get what? 20 as the unrealized profit. It's 20. So that is the story behind that. I hope now we are together. Whoever that person was. So then we have that in realized profit. And when consolidating, we always say what? The unrealized profit must be eliminated in full, is it? Yes, unrealized profit affects our closing inventory, is it? It is like an error, because it means that the closing inventories are overstated, is it? By that profit. So if we have an overstatement of unrealized profit on our closing inventory, it means what? The profit is overstated, is it? Yes. So we must adjust our cost of sales to reduce the profit. That's why we add it to the cost of sales. So that is that. Then we go to the next. The next one is the same. Number 4. In the year ended that 1st March 2013, Leo Limited sold to Jana Limited goods at a price of shillings 90 million. Leo Limited had marked up these goods by 80% on the cost. That is still markup. And that is still another intra-group sales, is it? Yes. Another intra-group sales of Leo selling to the Leo to Jana, subsidiary to the parent. Yes, that's what we call an upstream transaction. And those goods were worth what? 90 million. Are they still in stock? That's the second question you ask. If all those goods were sold, there will be no unrealized profit, is it? But if they are still in stock, or a proportion of them is still in stock, it means we have unrealized profit. So do we have any unrealized profit? Yes, we are given Jana Limited held 25% of these goods in stock on that 1st March 2013, which means we have unrealized profit. Unrealized profit. And that unrealized profit equals what? One, value of goods in stock is what? 25% of the 90. 90 is the selling price, isn't it? So it is 25% of the selling price. So the value of goods we have here is at selling price. Therefore, you must do what? Convert your markup to margin. Markup is given there as what? 80%. So what is margin? 80 over 180. You simply add the numerator to the denominator. And the numerator remains the same. So that gives you what? This times this you get. Huh? 18. 10. Eh? That 10 as the unrealized profit. Number 5. On 1st April 2012, Jana Limited sold sewing machines to Leo Limited for shillings 150 million. Leo Limited included these machines in its non-current assets and charges depreciation at 20% on cost. Jana Limited had marked up these items at 50% on cost. Leo Limited includes the depreciation on these machines in its cost of sales. So again, we have another intra-group. I don't know whether it is intra-group sale or what is it. What is it? We have intra-group sale, is it? Because initially, at the beginning of the question, we were told that Jana sells what? Household machinery, is it? Yeah, Jana Limited distributes a wide variety of household machinery, including sewing machines. So that means Jana, the parent, sells those household machinery as a normal, including sewing machines, as a normal sale, is it? Yes. That is, and it is Jana who is selling to Red. Goods worth 150. So to Jana is a normal sale. But we are given on the other side that this Leo included this sewing machine as an non-current asset and depreciated it on cost. Yes. So it's like Jana sold to Leo. This item was not meant for resale, is it? It was meant for use in the business. What does that mean to the group? That means to the group that this item has not been sold by the group. From the group point, it is still within what? The group. And it is not part of inventory. It is part of non-current asset. Therefore, we need to cancel this sale from the group point. We cancel this sale by removing these sales as well as the cost of the item that was sold. Because by Jana selling to Leo, it reported sales as well as cost of sales. Yeah, that is to mean it reported a profit. And that profit was what? It was sold at a profit of what? Yeah, we are given. It includes Jana Limited had marked up these items at 50% on cost. Is it? 50% on cost means markup. So what is the profit on sale? Profit on sale. What's the profit in this one? 50. Given the profit markup is 50%. We must apply what? Margin, is it? And the margin equals what? 50 over 150 times the selling price 150. And we get a profit of 50. That means the profit was, no, the cost of the sale. Cost of sale equals what? 100. So Jana reported a sale of 150 and a cost of sale of 100. But this item is not yet sold, is it? It is still within the group, from the group point. It is still within the group, and even it is an uncurrent asset being depreciated on cost by Leo. And Leo provided depreciation of 20% during this year, is it? You can see the sale was on 1st April 2012. That is at the beginning of the year. So a whole year depreciation was provided. And now, since we are saying this item is not yet sold, it is being used, we should depreciate it on the original cost because it is still within the group. It only has been transferred from one point from Jana to Leo, and it was transferred at a profit of 50, which means Leo depreciated. The cost to Jana to Leo is what? What is the cost to Leo for this item? Cost to Leo is equal to what? 150, is it? But to the group is what? 100. Therefore, Leo has been depreciating profit, is it? Yes. What is the profit? What is the depreciation provided on the profit? And that is then the depreciation overcharged. That we require to do what? To adjust. So depreciation adjustment will be equal to what? It will be equal to the depreciation on a profit. Yeah. Which is equal to the rate of depreciation is equal to 20% on the profit. Yeah, that is the profit is the selling price minus the cost. So that you get the depreciation overcharged on that profit. Because that profit we must eliminate it. And also therefore we eliminate the depreciation expense provided on it. And that gives you a depreciation of what? 20% of 50. 20% of 50 is 10. That is to be removed. Yeah, you remove it from where? We are given. Leo Limited includes the depreciation on these machines in its cost of sales. So that means it is already classified as cost of sale item. You remove it. Reduce the cost of sale. And also increase the asset because it is an overcharged depreciation. Then next item is what? Assimilation. This is what it is. We are given another item. Number 6. On that 1st March 2013, all the intercompany accounts in respect of intercompany trading agreed with Leo Limited owing Kesho Limited shillings 24 million, and with Jana Limited owing Leo Limited 18 million. That is what we used to call what? Intragroup balances. Yeah, group companies owing each other. Either subsidiary owing the subsidiary, or subsidiary owing the parent, or the parent owing the subsidiaries, or owing subsidiary. What they owe each other in general. And in this case, we are only given, it is equal to what? The 24 million and the 18 million, which is equal to what? 42. That needs to be eliminated from our receivables as well as our payables. Then number 7, the accounting policy in the group in relation to goodwill is to capitalize it and test for impairment loss annually, or more frequently if circumstances indicate that it is impaired. Goodwill was impaired by 20% as at the current year. Any non-controlling interest is stated at the proportion of the fair values of the identifiable net assets of the subsidiary. And realized profit on the intra-group sale of assets are eliminated from the assets and from profits of the company whose individual accounts recorded the profits, with an non-controlling interest bearing its proportion if appropriate. The charge for the impairment loss of goodwill is shown as a separate line item in the consolidated statement of comprehensive income. So what you have already computed goodwill, is it? Therefore, impairment equals what? We are told it is impaired by how much? Impairment. Impairment, it is equal to what? It is equal to 20% of the goodwill. The goodwill we have is 50 and the 60, is it? Therefore, 20% of what? 20% of the 110. And that gives you what? 22 as the impairment loss. That one we will charge in our income statement. Yeah, that is that. Then require the consolidated statement of comprehensive income, including the retained profit brought forward for Jana Limited and its subsidiaries for the year ended that 1st March 2013. So that is that. I think now presentation you can do, is it? See you now. That's fine. But you understand. If you can do that, I will be a very happy man. We close it at that, is it? Can you do that? Yes, you find it. You say quick fast. 5 minutes. It's an item of 5 minutes. Yeah. Sales, which are the adjustment for sales. Cost of sales, adjustment for cost of sales. Expenses, adjustments for the various expenses. Do that very fast. Do that very fast. Do that very fast. Yeah, we can, you see, you have to include it. We have Jana Group. Statement, consolidated statement, or that statement of profits and loss for year ended that 1st March 2013. So if we were to present the sales, we would present what? Parent 1368, is it? Plus subsidiary 774 plus subsidiary 685, is it? Minus intra-group sales 80 minus 90 minus 150, is it? You get what? 2507. Then we go to cost of sales. Cost of sales we have parent 810 plus 47 plus 355 minus 80 minus 90 minus 100. Then we add an realized profit plus 20 plus 10 minus depreciation over charge. Minus 10 bracket. So you get what? So that you get gross profit. Gross profits. $13.22. Then gross profit of what? 11.85. Then from there, we don't have other incomes. We have expenses. And the expenses we have distribution. Distribution we have 196 plus 64 plus 78. We are adding just like that because none of the subsidiaries was acquired during the year. They have been subsidiaries for several years. So this plus this equals what? Huh? 338. We have admin. And admin we have 112 plus 73 plus 72 plus what? 4. Depreciation, is it? Yeah, only work for 1 year. The other 4 charge it against the retained profits. We get what here? 261 finance cost. Finance cost we have 50 plus 20, is it? 70. We have impairment. Impairment, that is 22, is it? So profit before tax. Profit before tax. And that is equal to what? 494. Then after that, income tax. And income tax, we have both current and deferred. We want to show both, we have current. We simply add them together, 75 plus 43 plus 40. And you get what? You get and then you have 188. 158. And then deferred tax. For the deferred tax, we have 15 plus 15 is positive. Then it's an income plus an expense of 17 plus 10. So that gives you 12. And we get 170. So then we get profit after tax. Profit after taxation, which is equal to this plus this minus this, you get what? 324. Then how much of this is attributable to parent? Attributable to parent. And also how much is attributable to non-controlling interest. And the amount attributable to NCI, it is what is in the subsidiaries. Like for example, we have 2 subsidiaries. Leo subsidiary takes what? 20% of the adjusted profit. Profit after tax of this Leo, profit after tax is 150. Yeah? So which were the items affecting that profit? affecting that profit. We have two items. One, unrealized profit. Leo sold to Jana Group, is it? Unrealized profit is 10 because it is Leo that made that profit on selling goods to Jana. The other item, Leo purchased a machine from Jana and it was depreciated, is it? The depreciation overcharged on that machine is 10. So that is that. Plus, in Kesho NCI takes what? The parent will take what? 80% of 75, which is equal to what? 60. Is that 60? Yeah. Then that means the NCI takes what? 40%. Multiplied by the profit adjusted. And the profit after tax there is equal to 130. 130 minus unrealized profit, this one, 20, minus depreciation adjustment. Depreciation of what? Yes, so 20% of 150 is that. And 40% of this is equal to what? 42.4. So that means in total 72.4. So 324 minus 72.4 equals 250. 1.6. So that is the income statement. And after making these adjustments that are affecting that. Yeah, we are also required to show the group retained profit. Yeah, what is the group retained profit? So that we'll be able to get the group retained profit at the end of the year. You can see consolidated statement of comprehensive income, including the retained profit brought forward for Jana Limited and its subsidiaries. So group retained profit means what? Group retained profit brought forward. Group retained profit brought forward. And the group retained profit brought forward will always include one, the parent profit brought forward. Here, our parent is Jana, is it? Jana retained profit brought forward. And Jana retained profit brought forward is given in the income statement. It's equal to 767, is it? Yeah, in the income statement of Jana, we are given retained profit brought forward. Then we add. Remember, we are looking for the full group. We add a share of investees post-acquisition profit brought forward. So it must be post-acquisition profit brought forward. Yeah. Post-acquisition profit brought forward. The investees. We already have two investees. One of them is Leo. So in Leo, what is the parent share of Leo's post-acquisition profit? It will be equal to 80% of the profit brought forward in Leo is equal to 610, is it? Minus pre-acquisition as was provided in number 1, 490. So that is the post-acquisition profit brought forward with no adjustment to the previous year's profit. So 80% of that difference equals what? 96. Then also in cash. And in cash, the parent share is 80% of 75%, is it? 80% of 75% of the adjusted profit brought forward That is the profit brought forward. There is 420. 420 minus pre-acquisition of 300. What we get is post-acquisition profit. And it is the profit now we adjust with what? The depreciation adjustment. Is it? The 4. One of the 4, we charged it against the current year's profit. We included it in our admin cost. The other 4, so that we make 8, we charge it to previous year's profit, because it affected previous years. So that minus that minus that, you get whatever you get. 60% of that equals what? Yeah? So then we can say the group retained profit brought forward equals what? Equals 767 plus that, you get. You get what? 932 points. That is now what we will add profit for the year. We minus any dividend in case any. And there were no dividends, is it? Because were there dividends? Oh, they have already been, yeah. We have dividends there. That is dividends payable. So in that case now, we now present what? The balance sheet, is it? So to present your trade home. Yes, we present that. Then we go home. Jana Group. Statement of financial position. As at that 1st March 2019. So this is now also, we incorporate all the adjustments. We incorporate all the adjustments that are affecting our profit. So we have assets, non-current assets. We have property, plant, and equipment. And for the property, plant, and equipment, we take parent 653 plus subsidiaries 415 plus 495. There was an item of property that was revalued upward by 40. We show it. Minus its depreciation, 8. And also, there was another one that was sold at a profit of 50. What is that? This one. So we reduce it by that 50. And also, the overcharged depreciation of 10, we add it back. Well, right? That's the thing. So that now we get the consolidated PPE for the group after their adjustments, which equals what? Yeah? 15,555. 1555. Then investment in Leo and investment in cash, we replace with goodwill. Goodwill, which we combine 50 plus 60 minus impairment. And that is 110 minus 22 is 88. we go to current assets. Now you can see it is very tricky. All what you refer to as current assets are here. That is the inventories, the receivables, the cash. So any adjustment affecting our inventories, affecting our receivables must be made here, is it? So because inventories are part of our current assets, we combine them. For inventories, we remove and realize profit, is it? That is the 20 and the 10. For the receivables, we remove the intergroup balance, is it? Which is the 24 and the 18. Yeah, because you can see they have put them together as current assets. And our inventories together with receivables are our current assets. So we get what? We get what? Huh? That is the end of that side. We go to the other side, equity and liabilities. For the equity, we start with ordinary share capital. This one, we already show the parent. Parent only, 800. We have also retained earnings. Retained earnings, this much is here now, isn't it? Because we take the retained profit balance brought forward, 932.6, plus profit for the year attributable to the parent, 251.6, minus the parent dividend. Parent dividend equals 200. Just that. 200. And you get what? You get something like how much? $984.2. Then NCI, that one we must calculate. Let us first keep that one. And current liabilities. And for the non-current liabilities, we have deferred tax. Deferred tax. And that deferred tax is 121 plus 98 plus 84, is it? Current liabilities, you only that. Three. The other current liabilities we are given there 495 plus 47. So the only item we do not have is our non-controlling interest. Non-controlling interest. And our non-controlling interest will equal to what? We can still compute it here. Non-controlling interest. And we have NCI in what? We have 60 and 80. These are dividends payable. The intergroup dividends. You see, if you look at that income statement, immediately after the profit after tax, can you see it? We have something written what? Dividends payable. Dividends payable to who? To the shareholders, is it? Those payable by the parent, the 200, will be paid to the shareholders of the parent, is it? That is a liability. Those payable by Leo, they are payable to the shareholders of Leo. Who are the shareholders of Leo? NCI, 20%, is it? And the parent, 80%, is it? So of the 100, 80% is to be paid to the parent, is it? That is an intergroup liability, is it? Yes. The parent had not recorded it. So it is not a receivable on the other side. So we cannot remove it from there. But it is a payable to the parent, 80% of 100. Then also we have those payable by the subsidiary is 100. Of the 100, how much is payable to the parent? It is 80% of the 75%, which is 60% of the 100, which is dividend payable to the parent by the subsidiary. That is also a what? An intergroup, is it? The other dividends are payable to the NCI. Dividends payable to NCI, we cut them as current liabilities. But those payable to the parent, they are intergroup balances. You remove them in full. So our current liabilities will add up to what? 11. Then let us compute NCI. NCI 1 in Leo Limited. And here we are using the proportionate share of net assets. Proportionate share of net assets. In Leo, the NCI will take a share of what? 20% of the net assets. 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 And the net assets in Leo, as at the end of this year, comprises of what? Ordinary share capital liabilities. Then retained profit 6. After adjusting, we adjust with what? In Leo, we adjust with unrealized profit 10. Profit made by Leo on selling goods to Jana, that is 10. And also, we have an overcharged depreciation of 10, is it? So we add it back. Yeah, 10. So in that case, what is the NCI share of the net assets as at the end of the year? In Leo, you get what? 172. 20% of that. Then we go to number 2 in cash. And in cash, the NCI takes what? 40% of the net assets. Net assets in cash equals what? We can still accumulate them. We have ordinary share capital 100. There is evaluation that was never recorded. 40. Plus the retained profits of 450. But we must adjust this retained profit by eliminating unrealized profit of 20, by also eliminating depreciation of the 8, the depreciation on this fair value adjustment for the 2 years. And I think those are the only 2 items affecting it, is it? But again, so that is there. That is the end. Therefore, we have 40% of this is equal to what? 224.8. Then you minus the intra-group investment. Intra-group investment. The intra-group investment is the share of the investment to the NCI of REO. REO's NCI invested in cash, 20% of the 405. Yeah, that is why when we were computing goodwill on acquisition of cash, we only took 80% of the cost of investment, because the other cost is to NCI, which we now offset here, which we get what? 20% of 405 equals 81. So 172 plus 224.8 minus 81, you get the value of NCI as at the end of the year. As at the end of the year. As at the end of the year, which will be equal to what? 315.8. 315.8, and I think that is what we should put here as our value of NCI. Try to balance to see whether we may have done it like that. So balance, balance, balance. That 5. So that is the way, yeah? And I think that is the explanation you require. And you can see that is generally the explanation for all consolidation questions. Even the one that you will be given there, you will find that it may require the same adjustment. It may require the same adjustment. So I think at that point, we may stop there, is it? Do we stop there? Yeah, we stop there for the time being.